Today on the show,
I had one location. 5 years later, I've got 900 multifamily units. How does that happen? It was just a shift in mindset for me.
How to build a multifamily real estate investing empire. Welcome to the Not Another Real Estate Investing Podcast. I'm Dan Riando, joined once again by Brian Davis. Hi, Brian.
Hey, Danny. How you doing?
Good. Our guest this week is Gino Barbaro, who together with his partner, Jake Stenciano, run the website jakeandgino.com. They host the podcast Wheelbarrow Profits. Together, Jake and Gino manage and own nearly 900 multifamily units. And we wanted to bring him on to talk a little bit more about his model of creating passive income and building wealth through real estate investing. Gino, thank you for making time for us.
Guys, I appreciate the invite on. I'm glad to be here.
Do you want to just maybe start by setting up you and Jake's story, how you entered into the real estate market, and moreover, why you want to kind of share your passion with a larger audience?
Sure. I met Jake actually at my restaurant. I used to own a restaurant, had one for 20 years back in New York. And if anybody's in the business, they know it's a grind. And I'm excited to be on the show because I was stuck in that situation where I had that one location. I was actually an excellent operator. We had a great little place. The food was awesome. My dad's an old school Italian, so we had the great food. But unfortunately, like most small businesses, we were working, in the business and not on the business. I had one location. Now, 5 years later, I've got 900 multifamily units. How does that happen? It was just a shift in mindset for me. I met Jake 2011. He was actually a drug rep, pharmaceutical rep, getting catering for my restaurant. He said, you know what, Gino, I'm moving out of New York. I hate the taxes. It's theft up here. I'm going somewhere where there's nice weather, no state income tax, right to work. I like guns. So it was either Dallas, Texas, Knoxville, Tennessee, or some part of Florida. And he opted to go to Knoxville. I mean, it was that simple, believe it or not, and unfortunately 5 years later, I sort of did the same thing he did. I said, where's the weather nice? Where are the people nice? And, where's the great quality and cost of living and no state income tax? And I ended up in St. Augustine, Florida. So we started investing back in 2013, got our first deal. It took us 18 months to get our first deal, but we both just wanted to get out of the rat race. He was a pharmaceutical rep working 50 hours a week, going through 8 layoffs in 6 years. He made them all, but he just, he wanted to start a business. And I said, Jake, real estate, multifamily real estate, you can invest and create a business through it. And, on our first or second deal, I don't think he understood the concept. And now, fast forward now, he totally embraces it. And we're just going gangbusters right now.
Hey, Gino, could you describe what that first deal looked like to the audience?
Sure.
Maybe numbers, units,
yeah,
sort of thing.
Before we get into it, let me just tell you about the restaurant really quick. I just wanted to divert and tell you what my mistake was with the restaurant. And I think what I wanted to do with the restaurant was create a business within the business also. And unfortunately, my brother wasn't ready to do that. So we had the restaurant, which is a brick and mortar. And I'm just giving this to your audience just to let them think of if they're in a certain situation, whether they're an insurance agent or an attorney or an accountant, there's other ways you can create revenue in your business. And I was building up to that. But unfortunately, like I said, my brother didn't want to do it. We had a restaurant, brick and mortar. We wanted to start doing catering, which was an excellent form of business for us. We started doing cooking classes at the restaurant, which is another general form of revenue for us. We started doing weddings. We started doing barbecues, another form of revenue. We actually were entertaining the possibility of doing a food truck, which was a different form of revenue. I started selling physical products online, created the Gino's Family brand with my family, selling cooking videos, doing physical products, another brand. So I had the vision of trying to create ancillary revenues from that one little brick and mortar business. And I think anybody out there who has a brick and mortar business is feeling, stuck and saying, I can't generate enough revenue. I can't make enough money to pay these bills. There's always so many other facets where you can reach out and try to build a business and try to, I had a lot of fun. It was a lot of fun doing what I was doing. That was the other thing. I loved doing that. Being stuck in the restaurant, in the kitchen, not so much fun, but, building that business, that was a lot of fun. And from that, that's how Jake and Gino was spawned. So
what really was the reason that you went into real estate, and how did you transition out of that restaurant? Did your family stay with the business?
It's a great question. I mean, I'm the older brother, so I always felt it was my duty to take care of my younger brother, and we're partners, and it was difficult. I wanted to get out in the worst way possible. I wanted to leave the state because I needed a jump start. You get in your late 30s, early 40s, and you're saying to yourself, there's got to be more, right? There's got to be more than just going in every day and just punching a clock. And at the end of the week, you have this much money left over. And, back in '08, when the economy started slowing, I decided to myself, I want to go to coaching school. So I went to life coaching school for a lot of, that personal development, not to be a life coach, but just for the personal development. And that's what really triggered me, thinking about the big reasons, thinking about my why, and, what do I actually want to do with my life? And how do I just want to, continue to build a legacy for my family? And that's what led me to real estate. I had to go to multifamily, I guess fortunately, because I had a full-time job. I couldn't fix and flip houses because that was another job for me. So I said to myself, I can invest remotely with Knoxville, with Jake being boots on the ground and me doing it. I wouldn't say passively because, no business is truly passive. You're always either managing the manager, you're dealing with vendors, you're doing other stuff. But multifamily for us was the best vehicle because we were both working at the same time. Our first deal was a 25 unit deal. So, we could both manage that with no problem. I had a full-time job. So that's what really attracted me to real estate.
So your first deal is a 25 unit deal. Did you have real estate experience before that, or this was your first?
No, I wouldn't say a ton of it, but I made a ton of mistakes doing it. I bought my first deal back in '02. It was a fourplex in New York. Worked out pretty well. Then I ended up proceeding to make several nice little mistakes there. I bought a mobile home park with a bunch of guys that was not a good deal. Actually, the space is great, but I just, the guy that we did it with was not good. Ended up buying a mixed use commercial building in New York also. I just sold it last year after 10 years of pain and agony and grief and losing a lot of money. And then we had to, the restaurant in New York, which was mixed use also. So my whole thing was I decided to, after that, after that mixed use building, I said, I need to go get educated. I need to find a coach and a mentor. So I spent a decent amount of money, investing in myself and really learning the multifamily space. I said, before I go into another niche, there is differences in every niche, whether you're fixing a house, whether you're buying a multifamily, whether you're buying industrial or mobile home. So, I said, let me go get somebody who's doing multifamily. And that's what I ended up doing.
So 25 units, what are the numbers like on a project like that? And then where was that? That was in Nashville?
It was in Knoxville. Yep. It was back in February of 2013, 25 units. We bought it for $600,000, which now, it was, what is that, about 25,000 a unit. Now, obviously the market has really, really accelerated there also. But back at the time we got 80% bank financing. We had to come up with 10% of the down payment, and the seller, was old, motivated, wanted to sell, and they held 10% of the down payment as a note. So that was great for us. So we had to come out of pocket, all closing costs, for $83,000. I never forget that number because for me, I look back at that one little property, gave us the momentum to get into the space, gave us the confidence, and after your first deal, all of a sudden things changed a little bit.
Right, and you guys came up with that money yourself.
Yep. $83,000. Yeah, it was me, my brother, and actually Jake. The three of us came up with it. We split it 3 ways.
Right. And you still have that property.
We do. We actually refied the property back in 2015. The appraisal came in at $800,000. We refied and pulled out $164,000. So, we doubled initially what we actually put in. When you do that first deal, you make all the mistakes in the world. Our financing was terrible. We got a terrible interest rate. We got a 5-year term. We got a 20-year amortization on it. So, you make all the mistakes in the first one, but I don't want anyone to stop you, because if we had said, you know what, we don't know what we're doing, we're not going to do it. I thank the Lord every day that I did that deal because got us into the market. We refied it and we still own it today. And it's still per cash flowing us about $25,000 to $3,000 a month on that first little deal. Once we have all of our money out and then some on it.
Right. And then over the next 5 years, we're in 2018 right now. You've built that up to 900 units. And so what does that growth look like, and what's your current portfolio look like?
Sure. I mean, it's sporadic. I mean, we were fortunate that, as the market was going up, we were able to buy. And my thing, when I tell anybody, when I speak about real estate is, no deal is better than a bad deal. And what I mean by that is you really need to be careful when you're buying right. I see a lot of guys out there and I'm scratching my head and I'm wondering how the heck are they paying these prices for some of these deals? And, with private equity and money out there and investor money, people are just taking these huge risks. Their downside is so massive. So for us, we were pretty diligent on it. So, our first deal was in February of 2015. 2013. The next deal came in July of 2013. It was a 36 unit deal. That's when we found our second partner. Great guy. He had a really strong balance sheet, so it helped us out. Our third deal was a year after our first deal, which was 136 units. So we scaled up pretty quick because we understood the market. We liked the valuations. So we went from 25 to 36 to 136. Then 6 months after that 136 unit, we bought another 24 unit. Then we ended up buying a 281 unit property. So, I mean, we've been all over the board. And, what we focus on is mom and pop properties. We focus on those properties that are, they're too small for the REITs and they're just too big for the mom and pop investors. So our sweet spot, I'd say, is between 15, 200 units in that area.
Yeah. What's your acquisition strategy currently look like to get those into the mix?
Yeah, well, back then we were looking at 8 caps. 8 caps are like a day of the past right now. So if we can look for something in the 7 cap range in our market with, everyone's always talking about true value adds. You have to get a property that has, some type of rent growth. We're looking for properties that are $100 per month under rented. We're looking for properties that have the ability to, institute some type of fees on there. Maybe if people aren't billing back for water, we're looking for properties that are mismanaged, that have high expenses, because we have our own property management company. So we manage the properties ourselves. And we're looking for properties that are suitable and that they're in the C space, guys that are, blue collar tenants. That's what we're looking for.
And are you doing that through relationships with real estate agents in the markets you're looking in?
Yeah, unfortunately, yeah. And that's what multifamily real estate, and that's what the name of the game is. It's really broker driven, and it's a little different than residential. I like the residential space because it's really getting disrupted by a lot of players in the market. But multifamily, there's still the good old boys network where everyone, they hold the deals. And the way the market is elevated right now, it's really hot. They put stuff out. If you don't know the broker and you can't get in front of the broker and make relationships, that deal's going to be gone. The days of listing stuff on LoopNet and CoStar and sitting there, those days are gone. I mean, I only use LoopNet to see what brokers are in the market. Other than that, it's pretty much difficult to find deals there right now.
Right. So you bring these properties into your mix. How do you deal with them? How do you have your own property management company, or do you outsource all that?
No, we have our own property management company. We started managing is almost by default. I always told Jake, let's start managing our properties from the beginning. Let's take our lumps. If we don't like to manage, we won't manage. If we do like it, we'll just grow a little property management company. And for us, I mean, after the year was up, after our first year, we had the 200 units. Jake was fortunate enough where he said, listen, I'm quitting my corporate job. I'm doing this full time. So he went into it full time, and that's what he started doing. Now, there's some pros to it and there's some cons. I think the pro to it is you're able to control, you're able to generate more revenue, but you're able to drive that NOI and really take care of your properties. The negative is sometimes it takes away your focus, and you're not focused on continuing to grow your assets and buy and strengthen your portfolio. You're trying to grow another business, and you're not really an asset manager anymore. You're really getting into the day-to-day operations, which, I mean, for us, it's worked out, but there's a lot of guys in the space that don't want to deal with third-party management. They just want to continue to underwrite deals and, and build their portfolio. I don't think there's a right or wrong answer. There's just certain differences in philosophy.
Right. All 900 units is everything in Knoxville currently?
It is, and it's not syndicated. So we've been able to refinance all of our proceeds and just roll them into the next deal, which I think makes us, I wouldn't say unique, but there's not many guys out there that, control their portfolio. And we're looking to syndicate now, actually, our first deal. We just never felt comfortable taking money from investors. We were fortunate enough to reposition these properties, pull out money. We've been able to refinance up till now around $8 million through the portfolio. So all that money is just, been put back into the portfolio and just been able to grow. We've got a really good, LTV on the portfolio. I'd say it's about 75%. So, our debt load is good. So we just continue to buy. We like to call it refi and roll. Just refinance the property out, find that next deal, and just put it into the next deal.
Right. And so your partner, he is mainly in charge of the property management side, and are you more or less the acquisition side?
He does property management. What I'm doing right now, focusing most of my efforts, is on the education side, the Jake and Gino side. And I would say they're pretty much symbiotic. It's weird because when you start doing the education, you start meeting new vendors. You start, we had a live event last year, so you start attracting different kinds of people. You start creating an investor database. You have a nice podcast. All of a sudden, people are hitting you up and saying, "Hey, listen, I'd like to invest with you." just getting great ideas and making those great relationships. You meet new mortgage brokers, you meet new real estate brokers. So he's got that aspect of it. We've got the education, and now we're deciding to open up a syndication arm of the business.
Right. And so your main focus is value add multi-unit, correct?
Yep, correct.
So what are some ways that you add value to these properties? Are they typically just properties that are the vacancy rates are really low? Or are there other sorts of creative ways that you guys are adding value and pushing those rents?
What I'll do is at the show, I will leave you show notes. I've written an article that says 15 ways to increase the NOI on a property. And what your main focus is really knowing exactly what it costs to run a property. For instance, a property might be overexpensed. They might be wasting money on expenses. Another thing that people like to do in the space is a lot of mom and pop tenants don't bill back water and sewer back to the tenants. They're paying it themselves. That's a huge money generator for us. And a lot of our properties have been that. And you'd say, why would they do that? Mom and pops don't know any better. They have no systems. They don't know how to run the property. They're running it the way they've been running it for the last 30 years. Other ways, instituting application fees, instituting pet fees. We've put in, fitness centers. We've put in dog parks. You like to add amenities. You like to try to create an environment in your property where you're going to keep those tenants and you're going to maintain those tenants. And what's really happened in the last 4 to 5 years, rent growth has been, I wouldn't say outstanding, but it's been excellent for the last 4 to 5 years. It's just the market's been going up, the economy's been going up, and I think the demographics for multifamily have been good, and they're going to be good because people are just not buying homes. Families are getting put off, so the millennials are just renting longer. The baby boomers are starting to retire, and they're downsizing. So we're seeing those rents, 3 to 4% a year, just naturally over the last 4 to 5 years. So if you can buy them, you can maintain them. They're great hedge against inflation.
Right. Okay. So you're all in one market, and you're looking for tenants all in that area. What kind of marketing efforts are you using to get tenants in and to have this pipeline of tenants so that your properties stay occupied and you can keep the value in the properties that you have? And what's that competition look like with
this may seem crazy to people, but one of the biggest draws we use is Craigslist. Don't ask me how or why it works, but in our market, it really works well. And I think the second thing I think anybody needs to focus on is it's not a passive business. It's all customer service driven. People will not leave your property because the rent goes up by $5 or $10. They will leave your property if you don't take care of a leaky faucet or a toilet that's running or a stove that's fixed. I mean, on our third property, I'll never forget, we bought it. I would say we're general newbies. We were on the property for a year. I remember getting the service calls and, going out and fixing this guy's stove. Comes in the office, the guy the next day, and he's crying. And Jake's like, what's going on? He's like, listen, I've been trying to get my stove fixed for 6 months and they never came to fix it. So one of the best things you can do is get a referral, try to get a referral from tenants to refer their friends, but take care of the customer service aspect of it. That's where you're really going to reap the benefits, because one of the biggest costs you have other than property taxes is that tenant turnover. You're getting tenants moving out, and you're gonna have to fix the place up and re-tenant it, you lose time. So customer service is number one. We don't like to use Facebook as much. I don't know why. I think Facebook for the apartment is a little tricky because you get a couple complaints and you got a couple of bad reviews, and sometimes it's tough to take off. But we post on RentLinks and Craigslist. It works really well for us. And right now, I think on 900 units, I think we've got maybe 10 vacancies over the entire platform. So, the market's really strong. The apartment market is very strong, and we continue to push rents every year. The first of the year, we look to get 2 to 3% every year, and we haven't get any pushback on it.
Yeah. Do you guys look at single families or any smaller units in that market to add to the portfolio?
Well, we're looking at 100 units right now, and one of them is, they're quote unquote disjointed. There's a 30 unit, 20 unit, 15 unit. And what is enticing to us is they're pretty close to our other properties. So we're able to, roll that into the portfolio. We split it up into 4 different offices. So one of the offices will be able to take that property in. And just from the economies of scale, you're not going to have to pay the manager another 10%. You're only going to have to pay him a few $100 for that. So your contract services is already there. So, I mean, if a small 15 or 20 unit deal comes our way and is right next to our properties, we never say no to it, you know?
Right. Have you started looking at other markets in other parts of the country?
We are. What we're trying to do is we're trying to go within 3 hours of Knoxville. So let's say Atlanta. We're looking at something in Kentucky right now. Anything within 3 hours where we can start growing our management team and our management systems and grow it out that way. That's what we're looking at right now.
Very cool. Is there any interesting software or websites or maybe even podcasts or books that you'd want to share with the audience that you've been into lately, you've run across? What's like your current passion, I guess? Is it really growing the education side to bring people back into your business?
I like the passion. I like the education side. I mean, it's a lot of fun to sell stuff to students and to get them on board, doing blueprint sessions with them, just doing coaching sessions with them. I really like it because I like when guys are motivated to do something and you can really help them out and they're stuck in their job and they resonate with me because I've been there, I've done that. And it's just, I love to connect with them on that aspect. I mean, as far as websites, I'm not a big podcast guy. I don't know why. I just don't really listen to podcasts, but I do like to read books. So, everyone's got to read. We're starting a book club this month for our Jake and Gino community, and I've got a 15-year-old son who's reading Rich Dad Poor Dad. And I've read that already. I've got to read that again. But that's the book everyone's got to read. Start out by reading that, and I think everyone's got to start doing personal development. As far as the Tony Robbins, the Jim Rohns, the Zig Ziglars, I think people have to start there. And one of my favorites is Napoleon Hill, Think and Grow Rich. I think everyone has to read those books to really start getting out of your own way, start thinking about that little voice in your head, and just, start getting that personal development.
Yeah, very cool. Thanks a lot, Gino. We appreciate it.
Guys, thanks for having me on the show.
What are you reading this week, Brian?
I am going back through Crush It by Gary Vaynerchuk, or Gary V. I would imagine a lot of the audience might be familiar with his material, and I've read this book many times. I like to read books over and over again. Gary Vaynerchuk is basically my inspiration for doing a podcast and for creating the stupid videos that I create on YouTube. And Crush It is about using social media and content marketing to build your audience, and to do that to be yourself, to be honest, to share what you can with people, and to be the person that provides value instead of asks for value. And it's really about building your reputation, about building maybe a legacy or whatever you're going to be, and to just be you, to try to be the best you, and to present that to people and try to help people and give a shit about people instead of just looking to sell people something. So I think if you haven't read Crush It, it's hugely important if you intend to start a business or build a business. And I think even, for anybody, even if you just work a regular day job, you can get some really great insights from it. And you could always find your voice and find an audience. And if you have an audience of really loyal supporters, then life will probably be a little easier for you moving forward. So Crush It, Gary Vaynerchuk. I would recommend anybody that hasn't read that to pick it up, or even go find Gary Vaynerchuk on YouTube, and he provides some really awesome content.
Crush It, Why Now is the Time to Cash In on Your Passion is by Gary Vaynerchuk, and you can find a link to it in our show notes. That's all the time we have for this edition of the show. Be sure to rate the podcast at Apple Podcasts, and we'll see you next time.